We are Kappa Capital, and today we are going to be presenting to you our pitch book idea of H&M acquiring Steve Madden. I'm Michaela, and I'll be presenting with Alex, Angela, King, and Paige. We'll start off by taking you through our strategic rationale, in which we'll outline the main supporting points behind this acquisition. Next, we'll go through our analysis and valuation of the transaction. We'll then discuss how we'd structure the deal. Afterwards, we'll discuss the due diligence process. And lastly, we'll take a look at other alternatives for the target company, as well as alternative acquirers. The fashion retail industry is valued at approximately 1.5 trillion USD. The mass market subset that H&M and Steve Madden operate in is worth $35 billion. In the next 5 years, the apparel segment is expected to grow by 5.5%, while the footwear segment is expected to grow by 6.4%. The mass market apparel industry has a projected CAGR of negative 12.32% for 2020, which signals the need for product diversification. As for industry trends, only 6% of 2018's retail spending in the US was done through online platforms, in contrast to 32% for Chinese retailers. As a result of the pandemic, we expect to see consumer preferences shift towards e-commerce, thus enhancing online sales. Another effect of the pandemic is the increased leverage for conglomerates, as they have larger cash reserves to withstand multiple quarters of reduced revenues. Smaller companies are struggling to survive due to the concentration of fashion revenue among the top major companies. H&M and Steve Madden both have exposure to these trends. Therefore, the acquisition of Steve Madden presents an opportunity to diversify and prepare for future threats and growth opportunities.
Thanks, Michaela. Honing in on that last point, we wanted to highlight the industry trend of mass market fashion retailers consolidating to capitalize on economies of scope. Now, although this trend provides conglomerates with a competitive advantage, it also makes it increasingly difficult for smaller standalone companies to stay afloat, in addition to increased pressure from the pandemic. You may all be familiar with our acquirer, Hanes & Moritz, also known as H&M. They're a Swedish fast fashion conglomerate trading on the Stockholm Stock Exchange. H&M operates over 5,000 physical stores across 74 markets, in addition to 51 online platforms. The company has had consistently strong revenues, with a revenue growth CAGR of 9.1% year over year. And despite a 50% drop in revenue in Q2 from the pandemic, H&M's liquidity remains strong, with $1 billion in cash and cash equivalents. Further, H&M Group has taken rapid and decisive action to manage the COVID-19 situation through accounts receivable collections and strict cost control. This has led to a rapid recovery in results. H&M CEO has further emphasized that the group is now focused on ensuring financial flexibility and taking advantage of business opportunities in a challenging market. On to King to discuss cost synergies.
Our proposed target, Steve Madden, is a New York footwear company that designs, markets, and sells mid-market footwear. It operates over 227 retail stores across 80 countries, and prior to the COVID-19 pandemic, it has always had strong revenue growth, with a 5-year annual growth rate of over 6.1%. However, they have been greatly affected by the pandemic. For example, it saw a 198% decrease in net income in the first quarter of 2020 compared to last year, and they've been reporting a loss in each subsequent quarter until today. Industry studies have shown that a 2 to 3 month lockdown is predicted to result in a financial distress for over 80% of North American fashion retailers. Steve Madden is already in a fragile state and may not recover from another economic downturn. On to Angela to talk about revenue synergies.
Thank you, King. Diversification is a crucial component of our revenue synergies. It allows for increased variety in products and services, thus boosting brand image and company profitability. Diversification of our product portfolio will provide greater earning stability by strengthening shareholder value because we now have cross-selling opportunities and an expanded customer base. Further, as countries around the world recover from COVID-19 at varying speeds, access to a range of global markets will further benefit conglomerates like H&M. Diversification is a source of top-line growth for H&M, providing the opportunity to capitalize on economies of scope that we discussed earlier, thus competing against less diversified rivals. Revenue synergies have been calculated as follows. We first assumed an incremental sale increase of 2% in H&M and Steve Madden's shoe portfolio due to increased product selection and visibility. Secondly, we assumed a $150 million increase in our customer base, growing at approximately 1% per year, so an average cross-sell value of $90 and a conversion rate of 1%. Therefore, we calculated the effect of these synergies to a premium of 71 cents a share with an NPV of $1.2 billion.
Although in general, H&M is a clothing company, they do offer a few footwear items that overlap with Steve Madden, meaning that an acquisition will allow H&M to benefit from economies of scale. For example, H&M will have access to Steve Madden's exclusive network of suppliers and manufacturers, increasing their bargaining power. This includes Kai Hong Shoe Factory, a major footwear manufacturer in China for brands such as JCPenney and Dr. Scholl's. This will help H&M reduce their cost of production, especially for their footwear lines. This is especially helpful taking into account the fact that both companies do not own any manufacturing plants, suggesting that third-party suppliers are crucial to their businesses. We also realize that companies in this industry allocate a lot of their budget on sales and marketing expenses. For example, H&M sales and marketing expenses accounted for an average of 92% of total operating costs. And due to such similar consumer segments, the acquisition will help reduce administrative costs from standardizing procedures, eliminating role redundancy, and common geographical presence. Additionally, Steve Madden's boost in sales by 60% on their e-commerce website suggests how adaptable it is to market trends, another great benefit for H&M. Overall cost synergies are expected to total 20% from SG&A, cost savings, and production expenses. This results to a premium of $1.37 per share and an NPV of over $2.4 billion.
Thanks, King. Moving on to our final strategic rationale, which is centered around the idea of the deal's timing and the opportunity that H&M has to take advantage of some of the ongoing trends we're seeing in the markets today. The first one being the low interest rates that have been brought about due to the pandemic. According to the current US Fed chair, these rates will likely remain close to zero for the next few years. Even with the incoming Biden administration, there aren't likely to be drastic changes to this plan. At most, the first interest rate increase is speculated to be moved up 1 year to 2023. So, we believe this leaves ample opportunity for H&M to take advantage of the cheap debt that these low interest rates bring. Secondly, as previously mentioned in our industry overview, the footwear market is seeing projected growth rates that are higher than that of the apparel industry. This acquisition would coincide with this trend, and thus we believe it provides an additional opportunity for H&M to see increased revenue growth. And now we'll pass it along to Alex, who will get into the details of how we valued this deal.
Thank you, Paige. Now shifting our focus to valuation, our group wanted to begin this process by gaining a better understanding of what the market was currently pricing Steve Madden at. In order to do this, we used a variety of valuation techniques, including a study of public comparables and precedent transactions. We constructed a discounted cash flow analysis using relatively conservative intrinsic assumptions, and finally, we did an overview of the 52-week trading range of Steve Madden itself. Upon completing all of this analysis, we concluded that a 21.8 times to a 25.8 times EBITDA multiple was an acceptable valuation range for the purpose of this transaction. When constructing an offer for Steve Madden, our group thought that it would be advantageous to utilize an appropriate amount of leverage given the current state of global credit markets. As such, we elected to use a buy-in management buyout structure, or a BIMBO. With this structure, we utilized various key assumptions and inputs. Firstly, we thought our key goal of this transaction would be to inherit and continue to incentivize Steve Madden's in-house design capabilities that has driven the operational success of the entity to date. Secondly, we wanted to maintain conservatism as much as possible when we were forecasting this out, and so we only included Steve Madden as a standalone entity in our forecast and realized that any recognized synergies would only increase the potential upside of this transaction. Finally, we utilized various revenue projections and cost assumptions, including a $15 million CapEx charge per year. Based on these assumptions and inputs, which we thought were extraordinarily conservative in nature, we concluded that this deal would yield a 22% after-tax IRR and was also accretive in nature. We would recommend that the board of H&M approach the board of Steve Madden in a relatively friendly manner with an initial offer of $31.67 per share, but have an upper bound of $45.50 per share to make this transaction happen. We also wanted to provide some insight behind the mechanics of our proposed BIMBO structure. After some research, our group found that it would be most beneficial if H&M established a new co and rolled over substantially all the assets of Steve Madden into that new co, with plans to roll over the brand into the overall H&M portfolio at a later date. This would provide several benefits to Steve Madden and H&M in the near term as well as the long term. First of all, Steve Madden's management would be able to maintain operational autonomy, while H&M shareholders would be able to benefit from any realized synergies or entity growth as a whole. Secondly, it would increase the overall tax shield of the transaction through the use of various U.S. tax selections. And finally, and probably the most important, is this proposed structure would protect H&M shareholders from any potentially unknown liabilities that Steve Madden may have in the near term. Throughout our structure, we utilized traditional leverage multiples and thought it would be best if H&M sought a syndicated term loan to reduce the exposure of any one financial institution. Perhaps the most interesting part of this structure is the use of a hybrid share swap or cash offering to entice the current shareholders of Steve Madden to realize the inherent value of this transaction. Through utilizing this approach, H&M would be able to decrease their initial cash outlay or equity check in this transaction and increase the potential upside they can see from it, while Steve Madden shareholders would be able to acquire interest in the transaction at a substantial discount to market and benefit from the upside of their work. Even if the share swap is done on a one-to-one basis, our group concluded that this deal is still immensely accretive and offers vast upside to all parties involved. I'll now pass it to Paige to discuss some of our due diligence considerations.
Thanks, Alex. So assuming that Steve Madden accepts H&M's letter of intent, H&M would then be free to proceed with their due diligence process in the following areas: finance and tax, HR, operational, and legal and regulatory. Some things they may have looked at or want to do during this process include having their financial statements audited, evaluating core versus non-core assets, reviewing existing compensation schemes and company policies, as well as creating a plan for employee retention. Because this acquisition does not fall under a restricted area of U.S. business, H&M would be free to make any financing arrangements prior to receiving federal approval. However, due to the size of the deal, H&M would still need to file a notice of acquisition with the Department of Justice and the Federal Trade Commission under the Hart-Scott-Rodino Antitrust Act. It's unlikely this deal will raise any flags, however, because the HHI value for this industry is well under the threshold of concern for competition policy. Due to the size of this deal, we estimate the due diligence process could take anywhere from 60 to 90 days. You might be wondering how we're planning to counter any resistance from existing employees and shareholders. As previously mentioned, we're hopeful that the way the deal is structured will help mitigate any of these issues. For example, by retaining Steve Madden's original management team, we will essentially be keeping their internal structure the same. This means no corporate culture changes and no concerns about how to best integrate existing employees into H&M's structure. Additionally, we feel the deal's one-to-one share structure offers existing Steve Madden shareholders an excellent deal. Thanks to the cost and revenue synergies that will be realized, the deal is accretive by a minimum value of 10%. We are confident that Steve Madden shareholders will see this as an attractive deal, thus persuading at least the top 15 investors to vote in favor. This would give H&M the necessary 67% of common share votes.
The alternative targets we have lined up are Caleres, Aldo, and Wolverine. They all have a strong market and e-commerce presence. However, there were also characteristics that could become risk for H&M. Caleres has a diversified portfolio of brands from athletic to orthopedic foot care. Aldo's business and financial troubles could be a burden for H&M, and Wolverine is a footwear empire on its own. The alternative acquirers we identified are Tapestry, Skechers, and The Gap. While all these companies have strong presence and an acquisition could create some synergies, there were also certain factors that don't align well with Steve Madden. Tapestry wants to go more with luxury items. Skechers focuses on technology rather than trend and design, and The Gap's cash flow makes it difficult for them to afford Steve Madden. Given all of these considerations, we believe that an acquisition of Steve Madden by H&M will increase profitability of the company, especially in the long run. Thank you for listening, and we're ready to take on the first question you might have.